Hey, good morning, everybody. Hope your Saturday's off, your weekend's off to a good start. If you're pretty much anywhere north of Florida, you're probably pretty chilly right about now. I think it was like 14 degrees when I came in this morning. A little bit of snow. We got about 5-6 inches here, not too bad. Nothing like what they've got in the Midwest, but I saw Alabama was even getting snow, so that's nice little winter going so far. Today will be a little shorter, I think, when I timed it out, but it's something that certainly not going to be a sexy topic, but it's pretty important. It's tax changes. So what things have kind of changed for 2023 and really headed into 24. What's it look like? Now, I think 24 is going to end up being, there might be quite a few more changes, at least by the talks of it, things that are out there. But 23, pretty boring year for taxes, which is finally something that I think we need, honestly, because it's been so crazy, the changes the past few years, that it's kind of nice to have a year where it's not that, not a million changes going on. So we're just going to kind of walk through that. But if you have any questions or anything like that, please throw them in the chat box and we'll get to those. But again, for this year, nothing really significant, nothing too crazy. They made some little changes on the actual 1040 as far as where things are positioned. But, it's for the most part a pretty quiet year for taxes, which is rare. Now, one thing that's going to probably affect a lot of people is, especially watching this, is the required minimum distribution rules and what's going on with that. So, that during the whole COVID thing, they bumped it up to, from that 70.5. That was always such a weird. I always had to sit and really think about that myself. All right, April 1st, after you turn 70.5, and it's just like, yeah. So they kind of changed that, which was good with the first Secure Act 1.0. But then in the second Secure Act that they did, or I guess 2.0 of the act, they basically kind of raised up the RMD. So with Secure 1.0, they raised the RMD age to 72. Now, so for people who were 72 in 2022, they still had to take an RMD by April 15th of 23, and then at least the first one, and then the second one would have been December 31st, 2023. Now, most people, what I always recommend is, what I recommended to clients was take the first one in 22 and then take another one in 23 just for tax purposes. So you double up on your tax bill. But Secure 2.0 actually started in 2023 and it raised the RMD age to 73. And it's also going to go up to age 75 for anybody born in 1960 or later. So basically Gen X or later, excuse me, is going to have until 75. So if you hit 72 now this past year in 2023, you don't have to take your RMD until 2024, which is this year. And you hit 73. So that's one of the things that kind of helped out a lot of people. And it made some changes there. But another thing that the Secure Act did is it finally kind of got realistic in that they're not penalizing people for under withdrawing for the RMD. So for instance, it used to be a 50% penalty if you didn't take out enough. So if you were supposed to take out $40,000 from your IRA for your required minimum distribution, the penalty would have been half that, or $20,000. So, I mean, it's ridiculous. It's crazy. So they finally put that down to 25%. And you think, well, I mean, at least it's a move in the right direction. But the nice thing is it can go down to 10% if the RMD is taken within 2 years. So if you just forgot or something like that, as long as you take it out, the next year or two after that, they're only going to assess a 10% penalty. Now, the penalty could be waived in its entirety, and it's always been the case. If the account owner establishes that the distribution was smaller than expected, because of an error, and they're remedying the situation. So this happens occasionally. I've had this happen a few times where, for whatever reason, the brokerage, I'm working with the brokerage and things didn't progress by December 31st. So it was kind of on the error of either the financial planner or the broker. And in those cases, I've had it happen, and we just write a letter and say, hey, look, it's pretty clear that the client was intending to do this. It signed the paperwork, so it wasn't their fault. And the IRS has always waived it. Okay. The other thing is they added some more exceptions for the early distribution to avoid the 10% penalty. Now, you can still, do things if you have, disability. If you're a first-time home buyer, you can pull out $10,000. All those still remain, but they added some more for people who can actually take a distribution from an IRA and avoid that 10% penalty if they're under 59.5. Private sector firefighters, public safety officers, state and local corrections officers, terminally ill individuals. And then if you over contributed to an IRA, you can do the corrective distributions and excess contributions without a 10% penalty. So where would that last one? That one could be like, a lot of times I've had people who have contributed to Roth, and it turns out they couldn't deduct it, or they over contributed to, I'm sorry, not a Roth, a traditional, and they couldn't deduct it, and we had to do a corrective distribution. Same with a Roth IRA. If they end up making too much money, you have to do a corrective distribution. Now, there could still be a 10% penalty under the old rules if you had earnings. So if you had earned some money on it, you'd end up paying a 10% penalty plus the income tax on the earnings. This will get rid of that 10% penalty. So it gives you a little bit more leeway if you're off a little bit in your tax planning. So that's good. The healthcare tax credit. So if you're on that, that was extended by 3 years in the Inflation Reduction Act. So the act that they passed here in 2023, it was supposed to, essentially what happened during COVID is they enhanced the premium tax credit. And now the Inflation Reduction Act has extended that by 3 years to 2025. So households with income that are no higher than 150% of the federal poverty level get 100% of the second lowest cost silver plan. So, I use this a lot, even with retired clients. If we can work their 1040 to the point where their income is within that, around that 150% of the federal poverty level, you can basically get your health insurance premiums paid for under this situation. And then even if you go above that, between 150% of the federal poverty level and 400%, you're still going to get some sort of subsidy. And then on top of that, if you're above 400% and you don't spend anything more than 8.5% of your household income on the second lowest cost silver plan. So even if you're making a substantial amount of money, but you're spending more than 8.5% of your household income, you still might qualify for some subsidy to get you back down to that 8.5%. So that's what, change going forward. We still know that the additional amount of the premium tax credit is going to carry forward for 3 more years. So that's good for folks who are on the Obamacare exchange. The child tax credit, that's something that affects a lot of people. And what they're doing is no change to the total amount of the child tax credit that you could get, but the refundable portion of it is moving up. So it's really a two calculation part for most people to see, if you get a lot in child tax credits and it zeroes out your annual tax bill. So if you have 7 kids and you're going to get $14,000 in the child tax credit, but you don't have a tax bill of $14,000. Maybe your tax bill is $10,000. Well, the way it would work is you'd be able to deduct the 10, but you wouldn't get the other 4. Well, they have made part of the child tax credit refundable. So that means you could possibly get the full 14, even though your tax bill was only 10. So essentially what they're doing now is for this year, the refundable portion that they could do would be $1,600. So going back to our other example, they had $14,000 of child tax credit. They only had $10,000 tax bill. Well, in this case, they wouldn't get the full 14. They get the 10, obviously, and then they get another $1,600. So they'd get $11,600 of tax credit, wouldn't get the full 14, but that extra $1,600, that certainly helps a family with kids. And then it's going to go down, or it's going to go up. I'm sorry, up to $1,700 for 2024. So good news if you have kids and you don't have a large tax bill, you should be able to get a little bit more of a refundable credit for the child tax credit. Another thing that probably doesn't affect anybody here that's watching this, but the earned income tax credit. So that's the tax credit for low income folks. And it used to be that you couldn't have very much investment income and get the earned income tax credit. And the reason for that is they didn't want somebody maybe retiring early, and you could configure your 1040 to show that you don't have a lot of income and you get a nice big tax credit, but yet you have massive amounts of investment income that you're living off of. So it used to be really low. In fact, I kind of got hit by this one year. My first year in business, my income dropped a lot. And I was thinking I was going to qualify, but I had a little bit too much in interest income that year, and it bounced me out of getting the earned income tax credit. But they've started to raise this a little bit. So now it's to the point for tax year 2023, the investment income limitation is $11,000. So you could have $11,000 of dividends and interest and capital gains and still be able to get the earned income tax credit. So if you're, lower income, or if you're kind of like I was, a transitional year, maybe you started a business, your income's a lot lower, but you still have some investments. Well, you're going to be in a position where you might be able to get this nice tax credit, because it can be a pretty sizable credit, especially if you have children. Another thing that will affect everybody, and it's kind of a positive, is what they're doing now is under the Tax Cut and Jobs Act. Back when President Trump was in office, they're tying the tax brackets to the CPI figure. So for 2023, basically with inflation being 7.1%, they've adjusted the tax brackets up. So if the tax bracket for the 12% bracket for married couples was $89,000 in 2022, well, they're increasing that by 7%. So that's going to get you up roughly $95,000 before you jump up to the 22% bracket. So all the brackets are moving up for 2023 by 7%. So that's going to help quite a few people, especially if you didn't get a 7% increase in your pay or Social Security or pensions or anything like that. It's going to make sure that you do get a little bit more of a tax break. Now for 2024, what they're going to do is increase these brackets by 5.4%. So still a pretty nice increase in the way that the brackets are going to move up according to inflation. So that's good. Tax brackets in the past had never been linked to CPI. So you might have the same tax bracket ranges for years, maybe even decades, before the Congress would come in and adjust them. So these are going to adjust automatically. So you're going to be seeing it go up with inflation, which is nice, because if your wages or your earnings in any way are adjusting by inflation, then you're not going to be necessarily paying more into tax. Whereas that wasn't the case when tax brackets weren't tied to CPI. And you had to wait for Congress to every 3 or 4 years make an adjustment. So you end up paying more in taxes just due to inflation. So now they're getting rid of that. So that's good. Now, when you look at the brackets, the 10 and 12%, you're obviously not going to see that much more of a break, but that's because it's 10 or 12%. 7% on 10 or 12% isn't nearly as much as it is going to be for people who are in the 22 through 37% brackets. That just makes sense as those bracket figures, which are bigger numbers, adjust by 7%, they're going to see obviously a bigger benefit. Another thing that is starting to adjust back under the Trump tax bill, they put something in there to increase the bonus depreciation. So companies that bought property to use in the business, at that time, they could elect to deduct 100% of that property under the 2017 tax change. You didn't have to do 100%, but they allowed some serious acceleration to be 100% of that. Now, there are some stipulations there. They had to be subject to the MACR's depreciation schedule, and it had to be for property or equipment that had a 20 years or less depreciation schedule. So it couldn't be something for real estate. They want to make sure that you couldn't, write off all the real estate or anything associated with real estate. But 20 years, it's, that's a pretty big, depreciation schedule there. So pretty much most stuff that companies are buying outside of land or actual buildings, it's going to be able to be depreciated in 20 years or less. So you could basically write off 100% of your acquisition cost. So that really opened up a lot of flexibility. Now, for 2023, we're no longer at that 100% figure. We're at 80%. And that's going to be reduced 20% each year until the end of 2026. So we're going to start to see that go away, and we're going to be back to the normal depreciation schedules that we've seen before. And there's still going to be the potential to deduct 100%. That's always been the case, but it's going to be a little bit harder to do. That's all. Meals deductions. So if you remember when COVID hit, restaurants shut down, they were really struggling. So the government said, all right, well, for 2022, you can deduct 100% of the cost for business meals purchased from a restaurant or food delivery. That way they were hoping that they could spark people to go back out to the restaurants and eat, especially business owners, do some more business meals or take clients to lunch, that kind of stuff. So they allowed you to deduct 100% of the cost for that. Before it was 50%, and now in 2023 and probably going forward, it's going to go back to that 50% cost. So you go out, take a client, you spend $100, you're only going to be able to deduct 50, whereas last year you could deduct the whole 100% or $100. There's a new tax for the corporate minimum tax. This was something that was part of the Inflation Reduction Act. And I don't really know why I'm discussing this with you all. Nobody is going to be affected by this per se. You may see a company you own, a stock you own affected by this, but they're trying to get to a minimum 15% tax on all companies. Now, it's not going to be on small guys. It's not going to be on little businesses. This is really only for SEC regulated companies. So this is for companies that report their income to investors. The other thing is, over a 3-year period, you have to have net income in excess of $1 billion or $100 million for U.S. subsidiaries of foreign partners. And then in the taxes, the difference between 15% of the adjusted financial statement income and regular tax calculated after foreign tax credits. So they're trying to shut down a lot of loopholes for corporations. And, when they looked at this, there's only 368 companies that actually meet the $1 billion or $100 million for U.S. subsidiaries of foreign companies. And the thing is, 241 of them actually paid more than the required 15%. So only 127 companies this is going to apply to. And you can see some of the companies: Amazon, FedEx, and Nike. So it's really going after Amazon, I think. I think they're coming after that. I'm also glad to see them go after Nike. I don't like Nike. I just don't. They sell their products for ridiculous cost, but yet they're, using slave labor in China. So I just don't like Nike. So I'm glad they're going to get hit a little bit here with taxes. But anyway, just thought I'd tell you that because that is one of the new taxes. Now, here's one area that is going to have or could have an impact for you, and something you might want to be thinking about for 2024 and beyond. The Inflation Reduction Act has made a lot of changes for residential energy credits, and these credits are going to carry through to 2034. So a lot of the tax credits had gone away for energy. They were starting to get rid of those. The Inflation Reduction Act has not only revamped it, but beefed it up a little bit. So for non-business energy property credits, it's now called the Energy Efficient Property Credit. As I said, it was kind of expired in 2021, but the Inflation Reduction Act has brought it back to life. The Residential Energy Efficiency Property Credit is now the Residential Clean Energy Credit. So that was going to expire at the end of 2022. So that's back on the table. Well, what does this really mean for you? So from 2023 to 2032, this is the Energy Efficient Property Credit. So this is the first one. Now, this used to be a $500 lifetime limit. So if you had made improvements to your home, you could take $500 one time, and that was it. But now that's going to go up to $1,200. So if you did take the $500 limit in the past for an energy efficient property credit, you still have $700 left. If you've never done it, obviously you've got $1,200. And the other little difference is you can take a credit equal to 30% of the cost of the home improvement if it's for your main home, your primary residence. And that's up from the 10%. So it used to be if you bought a energy efficient dishwasher, you could take 10% of that and deduct it up to that $500 lifetime limit. So if you bought an energy efficient refrigerator and energy efficient dishwasher, and that 10% of both of those costs it was more than $500, you could only take $500. Now you can do 30%, and you have a lifetime limit of up to $1,200. So it's a little bit better for those who are buying those energy efficient, durable goods and things along those lines. And some other little things that you can do that you couldn't do under the old rules. So now you can take up to $150 if you do an energy audit. So if you just have somebody come in and see how could you improve your energy usage, you used to be able to deduct $50 for that. Now you can do $150. And then for doors, so now you can do up to $250 for any one door, for a total of $500 for all your doors that meet the Energy Star requirements. Some other little things with it. You can do $600 if you're doing like an energy efficient air conditioner, water heater, furnaces, electric panels, things like that. You can even do $600 for exterior windows or skylights if they are Energy Star certified. And that's now $600, which is up from $200. So those are some other changes for the energy efficient property credit. Some other little things that you can do, and this is going to be on top of the $1,200. So, clearly you can do $1,200 for new fridges, new dishwashers. The other things I mentioned, the doors, windows, stuff like that. But they also have $2,000, additional $2,000 if you do a heat pump, a heat pump water heater, biomass stoves, and biomass boilers. So, I'm not sure how this is energy efficient if you're burning wood and wood pellets, stuff like that, but that is in there. So if you buy a wood stove, you could qualify for $2,000. And again, that's on top of the $1,200 that you can do. So if you really wanted to outfit your home, you could buy some new Energy Star certified appliances and maybe doors or windows and get up to $1,200. Or on top of that, you could also throw on a new heat pump and get $2,000. So if you're looking at replacing your system, you got lucky with the Inflation Reduction Act, you can now do a $2,000 for a normal, kind of a heat pump that you typically see now up, in the north. So the second credit, again, I mentioned, is the residential clean energy credit. So the first one was the energy efficient property credit. This is the residential clean energy credit. It's a non-refundable credit. And again, like we talked about with the child tax credit, non-refundable means if the credit you've earned from this residential clean energy credit is more than your tax liability, you don't get the extra money for that. So if you have $15,000 of credit, but your tax bill is 10, you don't get the full 15. Now, they did put it in law that you can now carry it forward to future years. So that $5,000 in my example that you weren't able to use, you can now carry it to future tax years, which is great because it always used to be a non-refundable credit, and people who did, solar systems, solar panels, things like that, geothermal heat pumps, what we'd end up doing is we'd create taxable income for them to make sure they could take the full credit because it wasn't able to be carried forward. So we would do Roth conversions usually, or we'd sell a position that had a gain on it just to get the tax so we could make sure we used up the whole credit. But now they have passed it where you can actually carry these the unused credits forward to future years. So again, this is for the bigger ticket items here. So we're talking solar panels on your house. A new one is battery storage technology. So if you put in a large battery in order to store the energy from the solar. Now, a lot of places when you get solar panels, you hook into the official grid that exists, the electric grid. And if you're not using all your solar power that's being generated, it goes back into the grid, and then the utility company will pay you for whatever energy you provide to the grid. Now, not all states do that, though. That's the thing. Now, I live in Maryland. They do. They hook you in the grid and credit you. And I think a lot of you I know a lot are in Florida. I have a lot of clients in Florida. It's another state that does that. But there are states that don't. So this was a way to kind of basically say, if you're going to lose the energy, like there's no way if you're generating more solar energy than what you're using and it can't go back into the grid and you get paid for it. Well, at that point, you could buy some batteries to store the extra electric that you could use down the road. Maybe when it's nighttime or, you're not getting that solar energy. So now they've added that in there. So you could put in a battery system and get the residential clean energy credit. Obviously, solar water heating systems. If you put I don't know if you could put a windmill in your backyard, but if you did, that qualifies. And then geothermal heat pumps are what you can do there. And one little change is you can no longer. It used to be if you paid for the solar panels, you could deduct it that year. Now you can't deduct it until installation is complete. So you want to make sure that, in the past, clients might do this on December 31st to get the tax credit. They pay for the panels. They got the write-off, but then the panels wouldn't be installed until the next year. Well, you can't do that anymore. So you want to make sure that the year you pay for the panels is the year the installation will be complete. Now, for newly constructed property, so if you're actually building a home, it's either when the installation is complete or when you occupy, whichever is later. So here again, if you're building a home, you want to coordinate that with when the installation is complete with the solar panels. Otherwise, you're going to have an outlay for the solar panels and you won't get the tax break until later in a future tax year. The other change here is there's no adjusted gross income limitation. So you could be Jeff Bezos, be the richest man in the world, or is that, I don't know, is that Elon? I don't know who's the richest, and I don't care. But there's no AGI limit. If you do this, you can take the credit. And the credit, again, is very substantial. So it's 30% for tax years 2023 to 2032. It's 30% of the cost of installing the systems. Now, after 2032, it does go down to 26% for 2033 and 22% for 2034. But 30% is a great deduction of if you're looking to do solar panels or something like that. And again, it does include the batteries that you're going to use to store the energy. So one thing, it no longer includes the biomass systems. So like I said before, the biomass system now is at $2,000 energy efficient credit. It's not this one anymore. So you can still get it if you get a wood stove. It's just you're not going to get 30% of it. You're only going to be capped out at $2,000. Another thing, sticking with energy, is the electric vehicle credit. So that also has been sort of, resurrected from the dead, and it's changed in a couple different ways. Now, the only downside of this one is you cannot carry forward any amount that you don't. It's not refundable, and you can't carry it forward. That's one thing. So if you do buy an electric vehicle and you're looking at the $7,500 credit, you need to make sure that you're going to have a tax bill that's larger than $7,500 so that you can get the full weight of this tax credit. As I said, it's been around since 2011, but it's been chipped down, and they brought it back to its prior glory at the maximum. So you're looking at $7,500, and then it will be reduced after 200,000 vehicles have been sold. It used to be that each model only had so many cars of that 200,000 that they could do. So it got to the point where most of the Teslas and GM cars and a lot of the Toyotas no longer qualified for this because they already hit the quotas. They took up their portion of the 200,000 vehicles that can do this every year. Now, under the new plan, the quotas have been eliminated. So if Tesla sells 200,000 vehicles and they're the first 200,000 sold, they can take all the credits for the year, and the rest of the car companies won't be able to do that. So the other little caveat is the 7,500 consists of two parts. So you can't just buy an electric vehicle and get the full 7,500. There's some stipulations. So the first one is meeting certain manufacturing criteria, and that means that the battery part of the vehicle is assembled here in the United States. So you can't buy a Volkswagen or a Toyota that's electric and get the full 7,500 if they're manufactured in Japan and Germany. They'd have to have some sort of assembly here of the battery components in the United States. And then the $3,750 also for the battery component criteria. So this means that the batteries themselves, a certain part of them have to be constructed here in the United States. Well, North America is what they're saying. Mostly it's to get it here in the United States, but we do have NAFTA, so it could be Mexico or it could be Canada as well. They did limit who can take this credit now. Before, basically anybody could do it regardless of your income level. Now it's going to be if you make $150,000 for a single filing taxpayer, $225,000 for head of household, and $300,000 for joint filer. So it's still going to basically apply to the vast majority of people. But Jeff Bezos is no longer going to be able to get that credit if he buys an electric vehicle. And the other thing is the credit is only available on vehicles that have an MSRP of $55,000 or less for new cars and $80,000 for the pickup trucks, SUVs, and vans. Also, you can, starting this year, the credit can be advanced at the point of sale. So if you go into your GM or Tesla dealership or whatever, I don't know, Tesla dealerships, or they just ship them, I don't know. But anyway, if you go into the dealer, you don't have to pay the full boat and then wait to do your tax return to get the $7,500. You can now get it right there on the spot. So they'll reduce the cost by $7,500. Now, in reality, what do you think is going to happen? The dealer is going to raise the cost by $7,500. And that's, you know what, that's what they find happens with these credits. All it does is Ford and GM and Tesla and all that, they boost the cost of the car by the credit. So really, you're not making out here. If the credit wasn't there, you probably still pay the same price. But anyway, it feels warm and fuzzy to get that credit. And if you do get any advance credit, and it's more than you would actually qualify for, you do have to repay it on your tax return. So you get that $7,500 credit. It turns out maybe the $3,250 of it isn't eligible because it was not assembled here in the United States or North America. You're going to have to pay that back on your tax return when you file. So that's one thing that's going to be a little bit tricky. Okay, so used vehicles. Used vehicles do qualify for this. They can get 30% of the sales price up to a maximum of $4,000. The vehicle must be at least 2 years old and have an eligible vehicle identification number. And the vehicle must be sold through a dealer, so it cannot be a private sale. So it still is eligible. The credit's only available in vehicles sold for $25,000 or less. So a new car is $55,000 or less. This is $25,000 or less. There are income limits on this as well, which are even less than for new cars. So it's only $75,000 for single filers as opposed to $150,000, $112,500 for head of household, and $150,000 for joint filers. So basically half of the income level than for new cars. Now, here's the tricky part is no credit could be previously claimed for the vehicle. So if the original buyer of that vehicle took the $7,500 credit or whatever credit was taken, then this car is not eligible. This used car is not eligible if you buy it. So that's a little bit tricky. I mean, I don't know how many vehicles. There was that $200,000 or $200,000 car annual limit. So each year, the credit only applied to the first 200,000 electric cars sold. So if you were the person who bought the 200,001 and you didn't get the credit because of that, well, that car would be eligible for the used vehicle credit. But I don't know how many of those are out there. So the problem is you really have to make sure that you know that you look up the vehicle VIN and try to find out if the credit has been taken already. And I'm not even sure how you do that, quite honestly. I probably should have looked it up for this presentation, but I'm not sure. But you have to be sure, because if you go to do your tax return and you put the VIN in, the IRS is going to run a check on that, and you might be expecting to get back, $2,500 or something, and you're not going to get it. Okay. And this doesn't apply to a lot of you. I know some business owners, but this can also be done now for commercial vehicles. So if you do have any kind of commercial vehicle that you use for business, and this is focused more on trucks, buses, vans, stuff like that. But also, even if you're going to buy a car for your business and you write it off, it's used 100% exclusively for business, you can get that $7,500 vehicle credit. So that's for cars under 14,000 pounds. And then if you're looking at the bigger stuff, a truck or bus over 14,000 pounds, that's eligible for up to $40,000 credit. So that's pretty good. So they expanded this to also help out if you're wanting to buy an electric vehicle for your business. I don't know if I need to go into this too much, but there's no limit to the number of credits a business can do. So if you want to replace your entire fleet, if you have 15 trucks, if you own a Penske renter, and you have 10, 15 trucks, you can do all of them and turn them into electric. So that's something that's different. And the way that you file it for it used to be you do a Form 3800. So, okay, the last thing that could affect a lot of people is the whole 1099K. Now, you may have gotten a 1099K last year if you sold anything through eBay, or if you did a lot with PayPal, you got paid a lot that way, Venmo, stuff like that. They're all required to issue 1099Ks. And they first started doing those in 2008. But basically what was going to happen was, it was supposed to start this year that they were going to start to tax this thing. If you had more than $600, if you had more than $600 in income, you were going to have to address it on your tax return. Doesn't mean it would all be taxable. In fact, it might be not taxable at all. If you sold something on eBay for $600, but you paid $1,200, you actually have a capital loss. So there's no tax issue, but you have to report it on your tax return. So from 2012 to 2022, you did have to report this or address it on your tax return if you had $20,000 in gross payments and 200 transactions. So it was really targeting people who had businesses on Amazon and eBay. But then, like I mentioned, in 2023, it was supposed to get to the point where it was only $600. So again, if you could rack that up. I sell used stuff on eBay all the time, and it's easy to get the $600. I paid more than $600 for all that stuff I sell, but you can get there. And the other thing is the number of transaction requirement was eliminated. So even if you had one transaction and you had $600, you were going to have to address it on your tax return. Well, so they basically punted this again. Maybe it's because basically the IRS is not ready with a form to address this at that level. So for 2023, the old rules are still in effect of $20,000 in gross payments and 200 transactions. So that's great. I think that's excellent. The $600 reporting requirement has now been bumped to 2025. So this will give the IRS more time as how you're going to address it. And I think they need to have a completely different form, because obviously if you're selling $20,000, you're probably a business. But if you sold $2,000, you might just be selling used junk out of your storage unit, and you probably paid more than that. So they're going to be different the first person's clearly going to be doing probably a Schedule C because, all right, maybe they've got costs, but they clearly have enough revenue. But the other people, it's a capital gain issue. So I think they need to have some special form, and I think that's what the IRS is focused on here. Okay, now, even though the $600 limit has been bumped to 2025, they are, at least right now, saying for 2024, they're going to look at $5,000 in gross payments and no transaction requirements. So even if you just had one transaction that was $5,000 in gross payments, you're going to have to deal with it on your tax return. Now, I think this will get bumped as well, but I don't know. At least right now, the rules are going to be $5,000 in gross payments and no transaction limits. So yeah, if you're gonna sell stuff on eBay, probably your best bet's to sell right up to that $5,000 limit, and you don't have to worry about it. And then in 2025, you'll have to think about it if you're going to sell stuff. Okay, and as I said, 2025, we go to $600 in gross payments. Okay. Really, I think that's all we've got for this one. So lots of tax stuff. I know that stuff's not fun. It's boring. Nobody likes this stuff, but it's important. And especially if you're thinking of, if you're going to buy a new refrigerator, if you're going to buy a new dishwasher, something like that, you want to make sure it's that Energy Star certification, because now you might be able to take that as a deduction. If you already used the $500, which pretty much every client I know has probably done that, because you know at some point you were buying a new fridge, a new dishwasher, a new washer dryer, something like that. You still have $700 now under new rules. So if you do need a new appliance or you want to do that, that's a great idea. If you're looking to buy a new vehicle, you might want to think about electric if you can get the deduction. So, if you're a small business owner, you can still, at least for 2023, get 100% of the bonus depreciation. It's only 80% now, but you might want to do it this year because that's going to keep going down over years. So it's important to know this stuff. It's important that at least you've heard about it. So let's see, questions. We put in a solar water heat system in 2015. What do you need to provide at tax time to get the remaining $700 deduction? Good question. I don't think you can take it because it's for new purchases for these years. So you still have $700, but it's not going to be for equipment you've already purchased and gotten a credit for. It's for, you have $700 credit left for anything new that you buy. So if you buy a new refrigerator, that would be eligible for another $700. But you can't go back in tax years like that and pull it forward. So it's unfortunate, but that's the rules that they set. So now if you do find that you need some new equipment, just make sure it's Energy Star efficient. Okay. It looks like that's all the questions. So everybody is either falling asleep because we're talking taxes, or I did a great job explaining all this stuff. But fortunately, not a lot of changes. And the other nice thing, as a tax preparer, it doesn't look like they're going to do any retroactive stuff like they've been doing the past few years, which has been just chaotic and horrible. Looks like this year it's going to be pretty straightforward. So that's good. And again, I'm thinking about doing something, and I'll send it out via a separate email, not a Coffee with Kirk, but like a Tuesday tax day, or, taxes on Tuesday. Just keep you up to date, because there does look to be some changes coming up here this next year. And it's going to be important that we find out about these things, and so we can so that we can make sure that as you go through the year, you take advantage of anything that they apply for this year, and you don't find out about it in 2025, and you're like, I could have taken advantage of that in 24. So I'll try to do that, be a little bit more on taxes. taxes are boring. People hate them, but they are important because, people fail to realize your biggest beneficiary isn't your kids. It's the government. So yeah, you need to make sure you give them as little as possible. Okay. Hope everybody has a great weekend. Stay warm. Crawl up on the couch, watch some NFL football. Feel bad for the guys playing in Buffalo today or tomorrow. Buffalo's tomorrow. Ravens today. It's going to be cold here in Baltimore. We'll see how the cold affects the team. So anyway, take care. Have a great weekend, everybody.